What are mutual funds? Mutual funds are investment products for private and institutional investors consisting of a portfolio of stocks, bonds, or other securities. So how does a mutual fund work? A group of investors are investing, usually monthly or once, in a big pot, their mutual fund. This fund is an independent investment company. They instruct a fund manager to manage the money for the investors. His task is to invest the money to produce capital gains or income for the investors. He usually works together with a team and he can invest in different asset classes, for example stocks, bonds or other assets. The manager and investment company get paid by fees charged from the invested capital. You can see the details for the fees in the total expense ratio on your mutual fund's prospectus, a legal document that each mutual fund is required to file with the Securities and Exchange Commission. Other costs are usually added to the total expense ratio, such as the cost for the financial intermediary, which is usually between 1 and 5%. A financial intermediary could be, for example, the bank. Different types of mutual funds. In general, there are around 80 different types of mutual funds, but we are focusing on the 3 most common ones. Stock funds, as the name already implies, invest primarily in equity or stocks. This category can also be subdivided in mutual funds that are investing in small, mid or large cap stocks. Bond funds. Bond mutual funds invest in bonds and other fixed income securities to generate returns on interest income, which is passed on to the investors. And the last one, index funds. Index funds are very similar to ETFs. They invest in stocks and replicate a major market index such as the S&P 500. It takes less research for the fund manager, so they are generally less expensive. So what are the advantages from a mutual fund compared to other investment classes like stocks, bonds and real estate? First off, mutual funds have a much lower barrier to entry. For example, you can invest in a mutual fund already with a monthly investment of $50, while you need much more capital to buy real estate. So with the mutual fund, much bigger and more profitable investments are possible. The investment risk by mutual funds is also significantly lower through the use of diversification, as most mutual funds will invest in anywhere from 50 to 200 different securities. Some stock index mutual funds own over 1,000 individual stock positions. Another advantage is the issuer risk, which means in the case of a mutual fund company shutting down, all investors are returned their funds based on the last available net asset value before close down. And as already said, a big advantage is also the portfolio management, where you get for a relatively small price professional help in the management of an investment portfolio. Of course, there are also some disadvantages that are important to know as an investor. The downside of a managed fund are management abuses. The fund manager can abuse his authority for unnecessary trading, excessive replacement or even corruption. Secondly, the tax inefficiency. Investors do not have a choice when it comes to capital gains payouts in mutual funds. So investors typically receive distributions from the funds that creates unexpected taxes. If you want to learn more about investment products, click on those 2 videos and subscribe to this channel for more videos about investments, finance and economics. A like and a comment would also be appreciated.